Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Now, James Lord joins, Global Head of FX EM Strategy at Morgan Stanley. James, you got to rewrite to get to June 30th. You're going to do a mid-year review. Where is the big figure play in foreign exchange? If it's a blur, if it's complex, there's macro this, macro that, where is a place where I can actually speculate and make money on a currency pair?
Hey, Tom, thanks very much for having me back on the show. I mean, our currency forecasts generally see a bit of dollar strength coming through, but probably the biggest movers that we're forecasting are things like being short euro versus long commodity currencies and long risk currencies. I mean, the overall dollar environment that we're expecting to see is one of modest strength, but you kind of get a really split dollar where the dollar's kind of outperforming versus some of the low yielders, so things like Swiss franc and European, the euro, but really underperforming against some of the risk currencies like Aussie dollar, South African rand, Turkish lira. I mean, these kind of currencies are more risky ones. High yielders is where we expect to see the bigger moves.
I mean, Paul, I know you were like, you look at the vector of Euro Chilean peso,
sure, I'm all
which
over
you
that.
can do on the Bloomberg.
I know.
EURCLP. I mean, James Lord has got a tattoo on his left arm. And the answer is you've had a nice, smooth, strong Chilean peso.
Who didn't have that beginning of the year? So let's, James, let's just talk about the yen. That's been in the news here. We're pushing up close to 156 here, 155.73. What's going on with the yen? How do you think this is going to play out? What's the Bank of Japan going to be doing here?
Yeah, I mean, we think dollar yen's really driven by U.S. rates. I mean, clearly, what happens with the BOJ is important. But if you look at it sort of statistically, like most of the majority of the move in dollar yen is explained by how the dollar rates behave, and it's partly just simply because of the fact that they're clearly much more volatile at such a higher level of yield. And we're forecasting U.S. rates to come down. I mean, right. Matt Hornback, Gunit Dhingra, and team have U.S. 10-year back down at 4.1% at the end of the year, on the back of 3 rate cuts from the Fed, and that should support a lower dollar yen. So, I mean, it's difficult to buy it just because of the negative carry, but we see dollar yen going back down to around 140 by the end of the year, which is, I mean, it's a little bit more than what the forwards are suggesting, but it's not really a great trade considering the carry you have to pay.
So, given your interest rate outlook for the U.S. Federal Reserve, I mean, I just can't think of a dollar bear case. I haven't been able to think of one for a long time.
Like about 10 years?
Exactly. So, I mean, does the dollar maybe drift a little bit lower just on this rate environment?
Yeah, I mean, so if you take our U.S. rate forecast at just all else being equal, then it should suggest that the dollar comes down a bit. But the problem with that is that when we look at the yield differentials of the dollar versus on a DXY basis, that we're expecting to see bond yields fall by even more than what we're expecting to see Treasury yields fall. So, if the U.S. inflation comes down, it gives the Fed a bit more space to cut, then you're going to see markets price in even bigger easing cycles from the rest of the world. And, we think the ECB is part of that. So actually yield differentials will move, we think, in the dollar's favor. We still have U.S. growth outperforming the rest of the world, U.S. stocks doing very well. There's a lot to like about the U.S. dollar.
I mean, and your latest report, I mean, they've got enough people in this report.
I know,
it's like
and they got pictures, too.
It's like the sideline of the New York Giants.
Exactly.
And, it's like amazing. I mean, all of a sudden, you haven't talked to Amy Gower in like 10 years. All of a sudden, you're talking to one of your commodity strategists. What are people like Amy Gower telling you? How are they assisting you in speculation and investment forward, the commodity world? How do you bounce off that right now, James Lord?
Yeah, well, Amy's been very bullish on copper. She's had a great call on that.
Great call.
And it's clearly helping. You referenced Euro Chile. What that would have been a great trade. We think that is still a great trade. I mean, it's not. I would say copper prices are not feeding through completely into currency markets these days. Partly because this is a large part of this is a supply story. You've had mine closures, a lot of difficulty getting copper out of the ground, and that's really boosted the price. But it doesn't have the same impact on metal on currencies that really depend on the revenue of that, because the volumes are going down, and it's not necessarily an indicator of global growth if the price is going up because of supply reasons. So generally, you see that across all commodities. Actually, if the price is changing because of supply, it doesn't have the same impact on commodity currencies as you would typically expect.
But James, this is important. The heritage of Morgan Stanley on commodities goes back to Ruchir Sharma, now at Rockefeller. Is Morgan Stanley saying there's a legit commodity cycle now, or is it a set of one-offs that put orange juice to the moon?
No, I mean, we like metals. I mean, copper and other industrial metals are part of it. Gold prices as well. I mean, we do see some more upside in those names. Not a ton in energy and oil, but I mean, I think it's more interesting to look at it on the metal space, given the energy transition and some of the supply constraints that you're seeing there. And some of that feeds through into gold in terms of how the fiscal is evolving in the US. There's always concerns about that. And if the dollar goes down, then typically you would see some gold prices. If US rates come down, then typically you would see gold prices being supported. So I wouldn't say it's like across the board in commodities, but yeah, a little bit more selective and biased towards metals.
James, in the emerging markets here, we just had Damien Sassower on from Bloomberg Intelligence giving us his thoughts here. Yeah, where do you see the opportunities here, James? I mean, there's just so many cross currents here.
Yeah, I mean, we like Turkish lira, right? I mean, in this time zone, we think Turkish lira is a good story. I mean, it's difficult to having been through many cycles of the Turkish lira over the past 10 years. No cycles have typically been bearish. It's quite hard to sort of push a long Turkish lira view with a lot of conviction, but we do see that we do believe that the changes that are ongoing in that country in terms of policy are going to be sustained for some time. So we think Turkish lira will outperform the forwards. You can pick up some carry. We think that's an improving story.
James, we got to leave it there just because of time. James Lord, thank you so much. Greatly appreciate it with Morgan Stanley this morning, driving all of their foreign exchange. Really been anticipating this conversation. Joining us now from Wells Fargo with a really, really bright William and Mary take on asset allocation strategies, Tracie McMillion. Thrilled she could join us. Good morning, Winston-Salem, North Carolina.
Good morning, Tom.
Tracie, I look at your research note and it's just completely dead on about almost the numbness I felt this weekend about this great bull market. Color the exuberance for a stock market that you see at Wells Fargo.
Yes, thanks for having me on this morning, Tom. I agree. We've seen a lot of exuberance in the market since last October, and a lot of that has been fueled by better earnings. We saw an earnings recession turn to an earnings recovery, and so that's fueled some of that exuberance. But there's also just a lot of momentum in this market right now, and that also is fueling upturn that we're seeing.
I mean, what's really important to me is like the cab driver taking the twerp. They get off the plane and they get off the plane, Paul. They got to go to Wake Forest.
Yeah.
Is the cab driver or the Uber driver in your burg, are they talking about the stock market?
Probably so, and that's very reminiscent of the late 1990s, isn't it? So the difference, though, is that this time we are seeing these rises in the market supported by higher earnings, and a lot of policy has contributed to these higher stock market prices this time. So there's some fundamental justification behind some of the rises that we've seen. However, there are pockets of the market that are probably getting a little overpriced. Communication services has done really well this year. Information technology has done really well. Those are areas where we'd be trimming and putting that cash into short-term fixed income and just waiting for a better opportunity.
For that big correction to come in. Paul, just to be clear, Wells Fargo's got to publish 2025 of SPX 5700.
Oh, okay.
These are not, they're in the game. Wells Fargo's saying you got to participate.
So, Tracie, if we do want to go into some fixed income, lock in some yield here, do I stick with the Treasury market? I mean, I can get a 4.8% for a 2-year Treasury, or do I maybe take some credit risk? How are you guys thinking about that?
Yeah, so we're saying that in the shorter term for that cash, we would be holding short-term fixed income, and the Treasury market's a good place to do that with very little interest rate or very low credit risk, very little interest rate risk as well. And then we would supplement that with high-grade corporate credit. And we would be more concerned about investing in high yield fixed income at this point, especially since spreads have come in so much. We just don't see the risk reward value there that we do in corporate credits that are higher quality.
So, Tracie, back to the equity side here. I see a lot of spending coming out of Washington, D.C. for better or worse in, the Investment Reduction Act and so on and so forth, the CHIPS Act. Does that translate into maybe how I should invest? Should I look at some of the industries that might do well there? And if so, how are you guys thinking about it?
Sure. Yes, absolutely. We're looking at corporations, sectors that would benefit from both the CHIPS Act and from the Infrastructure Act. So we like companies that are in the materials space, the industrial space, energy space. And we also like healthcare, not as much of a beneficiary of those acts as the others, but also an area of the market where we see some value.
Right. What does Jay Bryson say then about international? I mean, bring it over to asset allocation. I've known Wells Fargo to be hugely U.S.-centric. Has that changed?
That really has not changed. We still have longer-term overweight to U.S. relative to the global market capitalization. And right now, we also have a shorter-term, more tactical positioning where we're overweight U.S. as well. And again, that's that quality theme, up in quality, U.S. large caps over small caps, and developed markets over emerging markets. We do go international.
One final question. I mean, if we go out 1 year, you're going to stagger into May, June of 2025. I can't believe I'm saying that. Does 60-40 work, Tracie McMillion?
Yes, 60-40 works out a year. In fact, we do see higher equity markets, as you pointed out, in 2025. And we also think that at these higher rates, bonds are offering very attractive opportunities for investors. So we do see 60-40 working, correlations starting to be less positive than they've been over the past couple of years, and that will have a diversification impact as well.
Tracie McMillion, thank you so much, with Wells Fargo. George Saravelos, he's with Deutsche Bank, writing brilliant notes. I just can't say enough about what he writes on foreign exchange as well. And we're going to bring in George Saravelos, and we'll do the Bloomberg Business Flash after that. George, I look at the theme into the summer, and to me, it's a jumble. What is your coherent theme into the summer?
Good to hear your voice, Tom. Good morning. So our theme is low vol persisting. In an environment of low volatility, carry tends to do quite well. So in FX, you should see more of the same. But I think a crucial point is the dollar is a high yielding currency. And if you think about the start of the year, so many people made the argument that if equities go up, the dollar should weaken, and the dollar strong despite equities at record highs. And that's because it's part of the carry trade. So we're positive on the dollar, and we're positive on carry as well.
Are the correlations in place across equities, bonds, currencies, and commodities, like the moonshot in commodities so much? Are those correlations normal right now into the summer, George Saravelos?
Well, I would say they're very different from last year. And this is something we've been writing about for a while, because if you look at the last few years, the world was dominated by this negative supply shock. So you had low growth, high inflation. That was bad for equities, and it was bad for bonds as well. But now we're in a more normal world, so to speak, and it's all about demand. Do you have demand holding in? And therefore, you can have yields still high, which you do, but equity strong as well, because the demand side of the economy is proving very resilient to these high levels of central bank rates. So I would say the correlation has gone back to being a bit more normal after being a lot more abnormal over the last few years.
So, George, give us your thoughts, your perspective here with a little bit of hindsight. What's happening with the Japanese yen? What has happened over the last several weeks? And kind of what's your view here?
It's probably the most interesting currency in developed markets at the moment. I think what's happening is simple, that the Bank of Japan is just too slow. It's very dovish, which means if you look at real rates in Japan, they're minus 2%. So everyone else, even the Swiss, have positive rates with a one handle or above, and Japan still stands out. So even though policy is normalizing, it's normalizing from such a low base that it doesn't do anything to materially erode that carry disadvantage which the yen has. So we think as long as the Bank of Japan goes very slow, which they are, the yen will stay weak. And they're going slow because they still don't believe inflation is at 2%.
Right, exactly. So if we think about the U.S. dollar then in that context, I mean, is there any reason to think this dollar will not remain strong here versus pretty much everything else out there?
Well, I think there are two ways you can get a weak dollar. The one is if you believe in a U.S. recession and therefore a sharp Fed cutting cycle, which many people did 6 months ago. But we haven't believed in that scenario for a while. So from my perspective, even if you get a Fed cutting cycle, it's not going to be steep. The dollar's still going to be a high yielder. So that's one scenario to get a weak dollar. The other one is if you get a weak dollar policy after the US election. And what I mean by that is not just statements on the dollar, but outright policy to restrict capital inflows, for example, tax on foreigners. We don't think that's going to happen either. Instead, we think we're going to get a restrictive trade policy. So we're in the dollar stronger for longer camp.
George, fold your expertise on foreign exchange into gold to the moon. And I'm going to state as a basic idea, at the margin, central banks are buying gold. If they're buying gold, are they owning less dollars? Give us a paragraph on that.
So many people, I think, look at the relationship between gold and the dollar and say, well, gold is going up because there's flight from the dollar. People are worried about U.S. fiscal sustainability, and therefore we should more generally be worried about the dollar. I don't think that's the case at all. If you look at what's going on this year, there's two things that are doing very well, gold and the dollar at the same time. So there's someone in the market there that likes both the dollar and gold. And I would argue this is the outcome of essentially decoupling and deglobalization, where if you look at China, for example, this is very public data. You have accumulation of gold reserves on the official sector side. But on the private sector side, the private sector wants to go into dollars. So you have capital flight from China away from the local currency, which is why the yuan is so weak. And it's going both in dollars and gold at the same time.
What's your euro call, please? I mean, we've got some people talking euro weakness to parity. Where are you on that?
So we have the euro effectively doing a range that's quite similar to last year. So if you think about last year, it was around 105 to 113. I would say the risks to that range are biased lower. But basically 1 to 110 for me is a range that's quite realistic for this year.
All right. Tom and I are thinking about coming over to London. We've got the suite booked at the Ned here. How concerned should we be about this, the British pound here? What's your call there?
I wouldn't be that concerned. The pound tends to follow the dollar in general. So if the dollar is strong against the euro, it's very likely it stays it stays expensive against the pound as well. You have to, though, think about one thing, which is the UK election coming up. It shouldn't lead to any major change in policy unless you get a tail surprise outcome, and I stress this is a tail outcome, of potentially the second party, because everyone expects Labour to be the first. If the second party that wins is the Liberal Democrats as opposed to the Conservatives, again, distant but not a non-zero probability, then you could have the market thinking of a much more pro-European stance that could help the pound. So it's a tail scenario, but it's the first time where it's a positive tail rather than a negative one.
George Saravelos, thank you so much with Deutsche Bank there. Your daily look at the front pages. She was looking at them through halftime of the Knicks yesterday. Lisa Mateo, what do you have?
All right, we're starting with the sports kind of centered thing since we were talking about the Knicks. Why not? Okay. Axios is actually reporting Amazon nearing a deal that would make its streaming service Prime one of the partners of the NBA, one of 3 partners of the NBA. So it's going to add a mix of regular season, playoff games to Prime. I mean, Amazon's been pushing, though, this sports streaming, you know, the NFL's Thursday Night Football. They extended a deal with the WNBA for 2 more seasons. NASCAR races coming too.
I'm so glad you brought this up because, Paul, I thought of you this weekend. It's not going to be like a gradual thing. The streamers are just going to say now.
When these deals come up for renewal, Tom, I think the expectation is on all sides that these big tech companies, the streamers, will be there. Thursday night Yankee games for the past couple seasons have been on there, and the old Yankee fans up in the Bronx, they're calling up sports talk radio saying, "How do I get the game tonight?"
Yeah.
I mean, and also I believe I may have this wrong, but Netflix Christmas Day football. 75 million, I think, per game.
I think so.
That's almost more than Taylor Swift makes.
Exactly. Yeah, that's because that's where the viewership is going. The cord cutting and all that. You don't get the bang for your buck with your broadcast and cable networks.
Next, Lisa.
Crazy. So Jeff Bezos' Blue Origin flight over the weekend flew, but you always get those like side stories out from each flight. So this one I thought was interesting off of it. It went off Sunday. Ed Dwight, he was America's first black astronaut candidate. On Sunday, he finally rocketed into space 60 years later, the age of 90. He was on that flight. So the backstory is he was an Air Force pilot when President John F. Kennedy kind of pushed him to be a candidate for NASA's early astronaut corps, but he wasn't picked for that 1963 class. NASA actually didn't select black astronauts until 1978. So he went on this flight. He called it a life-changing experience. Now he is actually a record holder, the oldest person in space by 2 months from William Shatner.
William Shatner.
Yes.
Captain Kirk.
He is 2 months older than William Shatner when he went back in 2021. So I love those like side stories from the launches that you get from that.
Very cool.
Very, very interesting. I like that one.
What else?
Sure. People working from home. So they're starting to take advantage of shopping online. The boss isn't looking over your shoulder. Right. You can kind of get a couple things done. So the research says the pandemic, sparked the rise in online shopping, but it's continued. Last year, we spent $375 billion more than we would have otherwise. So how do they know it's coming from hybrid workers? Well, they said areas where work from home jobs are more popular, that's where the shopping went up. And then areas where people are kind of back going to the office, that's where the levels went down a bit.
Where are people going back to the office? Where are these areas?
Nick Bloom, somebody had this, Diane Swank had this out this weekend. She does great work. Diane Swank, follow her on LinkedIn and Twitter, had Nick Bloom of Stanford, which says traditional firms, they're coming back.
Okay.
And the newer formation firms are embedded with work from home.
Okay.
That was the basic thrust of what Diane Swank was alluding to. I have to be careful. I have to be careful. What we are is I have the surveillance cork in my mouth because I'm very opinionated on this and nobody wants to hear it. But so we're working from home, ordering on Amazon.
Yes.
That's the thing.
And that's the thing. There's the people who work from home. They spoke to the Wall Street Journal. They're saying that they do it because they're not in the people in the office get the coffee break. They get to chitty chat with other people. They don't have that. So this is their release. So they're not doing it all the time.
This is critical.
Yes.
The chitty chat is part of the fabric
the workplace culture
of corporate interplay, I would say. Can you get to the marginal great idea or even good idea without the chitty chat? I don't think you can. Paul, it's like, let's do Zoom with our institutional sales force. No, you get Jamie Dimon said this in his annual letter, get on the plane and go.
Yep. I don't, I've thrown in the towel on this.
He's given up.
We'll let the new generation do their thing, and
Hey,
I'm
tell
sure
me
it'll
what you
work out
think on
fine.
live chat on this. Get out on YouTube and tell us what you think from work from home. The middle child has told me it's a complete scam. She's lined up, and the people are working from 9 to 11:42, and that they do like 6 hours of work in an hour and a half. And no one's policing them.
Right.
Yep.
I mean, that's just what the middle child says. I don't know. You gonna save us here? You got something next before I get to hook?
Last one. Okay, so you've seen them, like the different flavor combinations, like Peeps flavored Pepsi and pink lemonade flavored Kit Kats, like all these wild off the wall things. Well, yes, they're social media stunts, but experts are saying there's a little more thinking behind it. So the Wall Street Journal spoke with food companies, marketers. They said that the taste palette of the consumer is changing. They want more. They want a little bit of sour and sweet.
Sour Patch Kids Oreos?
Sour Patch Kids Oreos. I'm telling you. They want the best of both in one. Gen Z is also fueling that because they're a little bit more adventurous. They're on social media looking at these new flavor trends. But they're saying it helps the brands, right? So it helps bring in new customers. It helps show that they're fun and edgy, but it also helps nudge buyers to buy the original and the new flavor so they can test out which both. So now the customer is buying more. They're buying the original and the fancy new flavor.
Oddball pairings aren't entirely new in the food and beverage industry. Hubba Bubba released a bubblegum flavored soda in the late 1980s, for example. I remember that.
Just why I talked to Mondelez this weekend. They called me up. They said, thanks for the efforts on Tang Zero. There's Tang and there's Tang Zero. There's no Hubba Bubba Tang.
This is just on the margin. At the end of the day, consumer staples grow at GDP. I don't care how you package it, how you do all this kind of stuff.
And there's solid double-digit.
But I'll tell you what I do like. I do like the smaller serving sodas, like the
the tiny cans.
Yeah, because I'm not into the 12 ounce anymore.
Yeah.
So that thing works out perfectly for me. So whoever was thinking of that, good job.
Lisa Mateo, thank you so much. The newspapers. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.